Banks make billions of dollars of profit every quarter. To most of the people's understanding, banks make this profit from the interest cost they charge to its clients. But there is another secret that you probably want to know: how banks make billions of dollars. We'll talk about it in today's video. It is well known fact that if you are not smart enough to manage your savings, a big chunk of your savings will be eaten up by the banks in the form of overdraft fees, credit card fees, account maintenance fees and stuff. Even Henry Ford said this once, and I will paraphrase that. But not enough people understand the banking system and monetary system. The day enough people understand this, there will be a revolution the next morning. The banking system is designed to keep us poor. So we have to make sure we understand the system so that we go ahead of it. At face value, you work hard and you go to the bank to put your hard-earned money so that it is secure there. And whenever you need it, you can borrow in the form of loan whenever you need it from the bank. Let's take an example. Let's say you work hard to make $100 that you take to your bank to deposit it. Now your bank will deposit your $100 into saving account or checking account, and they will give you a receipt. That receipt is an acknowledgement from the bank, a promise from the bank that the bank owe you $100. You can show that receipt to your bank anytime and you can withdraw your $100. Now here the bank's job is to make profit, not for yourself but for the bank itself. So how does the bank make profit out of that? The bank start lending your money to other people at higher interest cost. The account that you open and put your $100, the bank will pay you a fraction of interest rate that they earn from the other people, which is higher. Now, bank is not allowed to lend the entire $100 to other customers. They are obligated to keep 10% in normal time and 90% they can lend. Now, I say here 10% in normal time because this percentage can change depending on the economic situation of a country. This is decided by the central bank. Sometimes the reserve ratio can change, like it changed in the pandemic March 2020 when the Federal Reserve instructed the banks to lend out the entire amount. In March 2020, the Federal Bank changed the cash reserve ratio to 0% to tackle the economic situation. So in that time, banks were no longer required to keep any amount in their reserves and they were allowed to lend 100% of the money. Now let's say the bank is lending the $90 to David at a certain interest cost in the form of credit card. Now David is spending that on a nice pair of shoes and he spent that $90. That money, $90, goes to the company's bank account. Let's say the company has a bank account with a different bank, a bank B, that $90 get deposited into bank B. Now again the same situation continues. The bank B again is obligated to keep 10%, which is $9, and then they further lend out $81 in the market, and this cycle continues. Now to those who are wondering how much money is created in this situation, it becomes a mathematical equation. The equation goes by the original amount that was injected in the monetary system. In this case it's $100, and you multiply 1 over the percentage of reserve ratio. To those who don't understand the mathematics, you don't have to worry. You just have to remember that your money, if you inject $1 into the system creates $10. 10 times money is created when you inject $1 into the system. So banks start charging interest on all that money, the artificial money that gets created through this system, and this system is called fractional reserve banking. Banks are backed by the Federal Reserve. So basically, if there is any monetary crisis, the Federal Bank can print more money, like most of the banks printed in the pandemic time to tackle the situation. So fractional lending creates a lot of money. Now you will probably understand why most of the banks give these lucrative offers like electronic devices, iPads, $300 cash incentive, $500 cash incentive to switch your saving and checking account with them. Now it doesn't mean that you should not save your money into your saving or checking accounts. You have to save the money to cover your emergencies because life happens. Save from 3 to 12 months of your savings to cover you in emergency, but rest of your money should go towards assets. Now in the fractional reserve banking, every time a dollar is injected into the system, bank multiply it by 10 times. So which means there is a more money available. More money creates inflation, and whatever the money that you are holding, it devaluates over the period. So dollar that you hold today has less power than the dollar somebody had 10 years ago. So basically, everybody should save their money into their saving or checking accounts only to cover their emergencies, and rest of the money should go towards assets which is giving you better return. I hope today's video was useful. If you like the content I create on this channel, please like the video and consider subscribing the channel, because this helps YouTube algorithm to spread the video among bigger audience. Thank you so much.